Hello everyone, my name is Adriana Calderon. I'm the lead partner of Transfer Pricing Solutions Asia, a consultant firm based in Singapore. And today I'm going to be speaking about managing the impact of COVID-19 on transfer pricing and specifically focusing on intellectual property transactions. So a little bit about our firm. We are a boutique firm that specializes in providing practical, proactive, and cost-effective transfer pricing advice to multinational companies with teams located in Malaysia, Singapore, and Australia. I'm the lead partner based in Singapore with more than 15 years of experience advising multinationals in how to manage their transfer pricing risk in a wide, broader industries, business models, and transactions. So for those of you who may not know, IRS released a transfer pricing guidance dedicated to the management of COVID-19 in September 2020. And this guidance was a welcome move from IRS, given that was issued at a very early part of the year in 2020 to give certainty to taxpayers on how to manage their transfer pricing adjustments at year-end. So in a nutshell, this transfer pricing guidance covered 4 key changes to transfer pricing analysis. Change number 1 was the recommendation on robust industry analysis to make sure that every taxpayer that is impacted by COVID-19 had very reliable figures on how the industry has been impacted negatively by COVID-19. The second point was the need of a robust functional analysis, especially when the taxpayers is recharacterizing entities. When there is a recharacterization of entities, there is a need to perform a functional analysis before and after COVID-19 to support the recharacterization. Also, a functional analysis to support which entities in the group made the decisions related to the management of risk related to COVID-19. Also, as a third part, IRS states that it is important to have evidence of any negative impact of COVID-19, whether in the form of a drop in revenue with a comparison of budgeted sales versus actual sales, or an abnormal increase of operating expenses. And last but not least, changes in the economic analysis, whereby IRS accept for the first time a multi-year analysis involving a 3-year analysis coverage for the tested party and compare that result against the benchmarking search or benchmarking result to make the decision whether a TP adjustment is required. So this is an exception or a very welcome concession from IRS, given that before COVID-19, IRS will only allow for single year analysis. So now we have that for 2020, a 3-year analysis is allowed if the taxpayer has been impacted by COVID-19. So how does this guidance apply to intellectual property, given that the guidance is very specific on how to deal with operating profits, but it keeps a bit silent on other situations. So let's go with the most common example that in our experience can happen when it comes to license and royalties. You may have company A, which is an entrepreneur, and that entrepreneur may be providing a license to company located in the US and to a company located in the Hong Kong. And it may have also a service provider, company B, that provides maybe contract R&D services or share services to company A. There are 3 key issues that can arise from this type of business models. So question number 1 or issue number 1 is, can the royalty be suspended? Issue number 2 is, can the royalty be reduced? And issue number 3, what are the considerations for service provider? So with issue number 1, whether the royalty can be suspended, that is something that taxpayers need to address on a case-by-case basis. But there is one important aspect, that the majority of royalties are priced based on a percentage of revenue. So if a company in the business model that is paying the license sees a significant reduce in revenue or a completely cease of revenue during a particular period of the year, that means that the royalty effectively will be significantly reduced. So in our example, if company US or company Hong Kong pay royalty fees to company A, and that royalty fee is a percentage of their sales, and those sales are actually significantly reduced or suspended for a period of time, what that is going to represent is a significant reduction on the royalty charge that is paid to company A. In terms of the possibility of reducing the royalty percentage, that is something that needs to be addressed in the context of having to perform a new benchmarking to support the new royalty rate. And the other aspect is to update or redraft an agreement with the new royalty rate. If this is an option that the taxpayer is considering, one key thing will be to do the benchmarking, to amend the agreement, but also to make sure that the taxpayer understands that it is not possible to do retroactive changes to intercompany agreements. And on point number 3, it will be what are the issues that have to be addressed for the service provider. And some aspects that can be challenging for company B here will be whether there is a need to reconsider the markups, whether there is a need to reassess the cost base that is being used for these services charge, or whether there is a suspension of the service for a particular period of time during 2020. So our top tips in this type of scenarios will be to first check the characterization of the entities based on the transfer pricing documentation and the contract, because the characterization of the entities will give the basis on whether there is a way to amend the price or whether there is a way to or which entities in the group will have to bear the losses. And it's very important in this point, our earlier comment from IRS TP guidance, whereby there has to be a documentation on which entity in the group made the decisions to manage COVID-19 risk. If contracts are available, there is a need, and hopefully, I hope by now most multinational groups have contracts, but if contracts are available, it is also advisable to check the avenues to modify the terms and the prices. And as I said earlier, any modification in the price will have to be based on benchmarking analysis. And last but not least, it is important to be proactive and monitor the end year result before the closing of the books, because if any transfer pricing adjustments are required, they will have to be performed before the closing of the books to be able to book them in the taxpayer or the Singapore taxpayer books. So that's pretty much everything we have for today. If you have any questions, feel free to reach us, or you need any assistance, feel free to reach us on this email or our phone number, or this is our website, and feel free to follow us on all our social media channels such as YouTube, Twitter, Facebook, and LinkedIn, as we are publishing very relevant content for multinational entities every week that can help you to manage your transfer pricing risk in Singapore and Asia. Thank you.